Hello and welcome, dear students. Let us continue with our amendment lecture, amendments applicable for May 20 and November 20, that is previous year 1920, assessment year 2021. We have finished till chapter number 14, that is assessment of electoral trust, and now we come to that chapter which has got maximum amendments in our whole syllabus. One of the most important chapters of your portion, MAT, that is minimum alternate tax, has undergone tremendous amendments, especially after the ordinance of 2019. The taxation laws amendment ordinance was announced. Let's see what are the amendments in MAT one by one. First of all, the amendment ordinance announced two new sections for corporate assessees, section 115 BAA and section 115 BAB. Two new sections have been announced for corporate assessees. The main purpose behind announcement of the ordinance was that company taxation should be relaxed. We want to provide a good environment to our industry, which is going through very bad and turbulent times. Consequently, it is decided to give two new tax sections for companies, 115 BAA and BAB, which I will be discussing as point number 5. The two new sections, 115 BAA and 115 BAB, both these sections, the two newly introduced sections BAA and BAB, will be introduced to you along with my point number 5. The first point is that these two concessional tax rate sections, there is a new section 115 BAA which is providing tax rate of 22%, and BAB for manufacturing companies is providing tax rate of 15%. In both these sections, there will be surcharge at 10% always. So, irrespective of your amount of income, irrespective of your amount of total income, gross income or net income, 10% surcharge will always get attracted. And as we are aware, HEC 4% any which way gets attracted always only. So, effectively it is going to be 22% plus compulsory 10% and 4%, 15 plus compulsory 10% and 4%. So, if you find out the net rate, because it is mandatory surcharge, so it is always going to be 22 plus 10% plus 4%. The effective tax rate for 115 BAA will end up becoming 25.168%. And if we talk about 115 BAB with 15% plus 10% surcharge plus 4% cess compulsory, this will effectively end up becoming 17.16. So, non-manufacturing companies will have an option to pay tax at 25%, including surcharge and cess, and your surcharge will come always. Even if your income is 10 rupees, there will be surcharge. And manufacturing companies will have an option to pay tax at 15%. Again, surcharge will come always, 10% and 4% cess. The net effective tax rate, if you understand, the net effective tax rate for 115 BAA is going to be 25.168%, and for BAB it is going to be 17.16%. These are optional tax rates, optional. And if you want to opt for these tax rates, you will have to leave a lot of tax benefits which you are taking in income tax. You are taking some tax benefits in business profession chapter, in deductions chapter. Leave all your tax benefits and pay tax at these ridiculously low rates. This is inclusive of surcharge, cess, everything. This is a very, very low rate of tax. Very, very low rate of tax. And plus another good news is that MAT will not be applicable to you. Minimum alternate tax will not be applicable to any company, which is, by the way, 115 BAA is optional, 115 BAB is optional. If you opt for it, your rate of tax will become very less, plus MAT also will not be applicable. That means now there is going to be strong motivating factors for companies in our country to leave normal rates of tax and come in these special rates, 115 BAA, BAB. What is the first benefit? We are giving them concessional rate of tax. And what is the second benefit? Very importantly, MAT is not applicable. Till now, MAT was applicable to all companies subject to certain exceptions like life insurance business or foreign companies that are opting for presumptive taxation, or foreign company in a country with which India has a double taxation avoidance agreement and the company does not have PA in India. foreign company from a country with which India does not have double taxation avoidance agreement, and the company is not required to register under any law of India. These were existing rules. I am only teaching you amendments right now. As per amendment, we are introducing two new sections for company tax. What is the benefit of these two sections? Two benefits. One, the rate of tax is very low. Non-manufacturing company, including everything, it will be 25.16 at final rate, and manufacturing company, including everything, 17.16 final rate. And second benefit, minimum alternate tax not applicable. So who are the companies, or which are the companies that will now continue in the old regime? The only companies that will continue in the old regime is those companies which have got very, very high amount of special tax benefits, which you are required to leave if you opt for 115BAA and BAB. There are certain tax benefits that you will have to leave. If any company has got those tax benefits, then that company will continue in the old regime. Otherwise, the new regime is very, very motivating. One, your tax rate is very less, and two, MAT will not be applicable. Obviously, 115BAA and BAB, very soon I will be discussing with you as my point number 5, so you will get better clarification. As of now, the only thing that I am trying to teach or explain to you is that once you opt for BAA or BAB, then minimum alternate tax will not be applicable to you. That's a big benefit we are giving to corporate assessees. Second amendment, again a very, very big amendment, very big amendment. Very few companies will now continue in MAT, first of all, because 115BAA and BAB are very motivating and MAT is not applicable. Very few companies will continue in MAT, and whichever company is continuing in MAT, the rate of minimum alternate tax is now being reduced. This is probably the first time since MAT was introduced in income tax. This is probably the first time where government has reduced the rate of minimum alternate tax. So till last year, the rate of MAT was 18.5%, but now the rate of MAT is going to be 15%. But only for those companies which are not going in 115BAA and BAB, because once a company goes in 115BAA or BAB, MAT is not applicable. So those companies which are not going in 115BAA or 115BAB, then in that case MAT will be applicable and at a reduced rate. So IFSC, it was already 9%, no amendment, but now for other companies MAT will be not 18.5 but 15%. So very easy amendment, very easy to understand. BAA, BAB I will be discussing very soon. Third is actually not an amendment. I wish to tell you some existing law. The normal rate of tax for domestic companies 30%, everybody knows this. However, if the turnover of the domestic company was up to 400 crore, in which year? In previous year, 17-18. So listen, this system that has been continuously being followed in income tax since the last few years is now being continued. That you have to check your turnover 2 years ago and 30% will become 25%. This system exactly started from the year 16-17. For 16-17, you had to check turnover of 14-15, limit was 5 crore and 25% tax. In 17-18, you had to check turnover of 15-16. In 17-18, you had to check turnover of 15-16. They increased the limit to 50 crore. In 18-19, you had to check turnover of 16-17, and this limit was 250 crore last year. And now for the year 19-20, you have to check turnover of 17-18. So listen, in previous year 19-20, what is the rate of tax of a domestic company? 30%. But if 2 years ago your turnover was up to 400 crore, this is the amendment. This is the amendment. So now you have to check turnover of 17-18. Last year you were checking turnover of 16-17. Now you will check turnover of 17-18, and the limit is increased from 250 crore to 400 crore. If turnover of 17-18 was up to rupees 400 crore, then your domestic company's tax rate will reduce from 30% to 25%. Tax rate of domestic company will reduce from 30% to 25%. And this is not an amendment, this is an existing section. 115BA, BAA and BAB are amendments. What was the existing section? That we are giving an option to pay tax at 25% for a domestic company incorporated on or after 1st March 16, engaged in manufacturing business. But the most important of all, you should leave your SEZ benefit under 10AA. You should leave your additional depreciation. You should leave your investment allowance which you are getting in 32AD. expenditure for scientific research which you are getting in section 35, or any income related chapter 6A deduction. If you leave all these tax benefits, then we will give you tax rate of 25%. This was relevant only for those companies which are falling in 30% rate. Any company which is already falling in 25% rate because of the turnover benefit can take all these tax benefits and pay at 25%. And pay at 25. But listen, that 25 will contain cess also of 4%. With cess, it will become 26. With cess, it will become 26. Even if I assume no surcharge, it will be 26. And in 115BAA, after adding surcharge and cess also, you are less than that. See. Basic tax rate, if it is 25%, whether there is surcharge or no surcharge, 4% cess will always come. If you only add cess, then also it will become 26. Obviously, if there is surcharge, it will become higher. And thus, if you observe carefully, 115BAA and 115BAB, 115BAA and 115BAB, after adding surcharge and cess also, you are saying in lesser amounts, plus the second benefit is that MAT is not applicable, and effectively it is understood that now all new companies will end up entering these two new sections, that is 115BAA and BAB, and MAT will not be applicable, which is why you can now say that the relevance of 115BA will get over, because any company falling in these tax rates and leaving the tax benefit would rather prefer that we should go in the new regime where even MAT is not going to be applicable. So this part you can ignore if you want. The only amendment that is applicable here is domestic company tax rate 30%. But if turnover 2 years ago, that is in 17-18, was up to rupees 400 crore, then we will reduce the tax rate from 30% to 25%. In 115BA, it was stated that once you exercise this option, you cannot change. That same thing is written in the two new sections also, 115BAA and BAB. Once you take this option, you cannot change. But obviously, if we are introducing two new sections, that is BAA and BAB, then we will have to allow companies to move to these sections, and therefore any company going for 115BAA will be allowed to withdraw the option of 115BA. So you can leave this option and go in BAA. Do you understand? In BAA with surcharge and cess also, your tax rate will be lower than what you will pay in 115BA, because here it will be 25%. Plus cess will make it 26, and in BAA it will still be lower. And all the tax benefits that you are leaving here, you will have to leave over there also. So everything else is same. If you strictly observe only the tax rate, in 115BAA all inclusive it is 25.168, and in 115BA it was 26, ignoring surcharge. If surcharge is there, it will come to even higher, and thus all companies will move to 115BAA. But in 115BA, the old section, there was a rule that once you take 115BA, you cannot leave. Agreed, you cannot leave, but you cannot leave and go back to normal rates. This new section will be allowed. In other words, 115BA is finished. So you just need to learn this portion. Normal rate 30%, if turnover up to 2 years was up to 400 crore, then 25%. You just need to learn this much. You don't need to learn anything beyond that. And BAA, BAB, now we are on point 4. In point 5, we will be discussing the two new sections. Let's finish point number 4 first. Let's finish point number 4. When we are computing our book profit, this point number 4 is with respect to computation of book profit. First, I would like to make you recollect the existing rules. What is the existing rule of computation of book profit? What is the existing rule? Start with net profit. Make one add side where there will be 15 adjustments. Make one less side where there will be 14 adjustments. Add 15 less 14, total 29 adjustments, and you will arrive at your book profit. One of the most important points on the less side, was brought forward losses. Let me give you a recap of the existing rule. Brought forward losses as per books of accounts. Brought forward losses as per books of accounts. Business loss or unabsorbed depreciation, whichever is lower, is the rule. Business loss or UAD, whichever is lower, is the rule. However, if the company has applied for insolvency and the insolvency application has been accepted, then we will adjust business loss as well as unabsorbed depreciation total. It won't be whichever is low, total will be adjusted. In that rule, we are adding one more assessee now. If there is a company or subsidiary of the company or sub-subsidiary, that is subsidiary of sub-subsidiary, where the National Company Law Tribunal on an application by the central government under section 241 of the Companies Act 2013 has suspended the board of directors or appointed new directors under section 242. So first it will require you to have some knowledge of company law. Under the company law, under section 241, the board of directors can be suspended on an application made, and the government can appoint, NCLT can appoint new directors, that is under section 242. So if that has happened, what has happened? BOD has been suspended or new directors have been appointed, then for such company, in fact for subsidiary of such company, in fact for subsidiary of subsidiary also, we will adjust both the brought forward loss as well as unabsorbed depreciation. Both the brought forward loss as well as unabsorbed depreciation shall be adjusted. Brought forward loss as well as unabsorbed depreciation, both will be adjusted. Both will be adjusted. Brought forward loss as well as unabsorbed depreciation. So if a company's board of directors have been suspended or new have been appointed for that company, for a subsidiary of that company or for a subsidiary of subsidiary, brought forward loss plus UAD, and company applying for insolvency and the insolvency application has been accepted, that company also, we know that that company also, the brought forward loss as well as UAD both will be subtracted. Okay. And now we come to the biggest change that took place with the help of the ordinance. New section 115BAA. First let's talk about BAA, then we will go to BAB. We are giving the company an option. It is an option. So you can pay tax at normal rates. Can I say normal rates will be 30%? Or with turnover criteria up to 400 crore satisfied, it will be 25%. But we are giving you even lower, 22%. But compulsory surcharge 10 and HEC 4. I already told you that the net rate will be 25.168. We have already computed that. Which company will give this, get this benefit? Which company will get this benefit of 115BAA? You have to be a domestic company. You have to be a domestic company. Very important condition. You have to leave the following benefits. 10AA, additional depreciation. These are all sections of PGBP. You get deduction for investment in asset 32 AD, 33 AB and ABA are tea, coffee, rubber. These clauses section 35(1) section 35(1) clause 2, 2A, 3 are for expenditure on scientific research. 35(2) AA is also contribution. 35(2) AB in-house scientific research and development. 35 AD specified business. 35 CCC is for agriculture extension. 35 CCD is for skill development or any income related deduction other than 80JJAA. 80JJAA is for giving employment. That is allowed, but others you will have to leave. And in fact, with respect to all these deductions that you are leaving, if there is any brought forward losses, then you will have to leave all that. In other words, you will have to leave all the tax benefits, special tax benefits available, and pay tax at 25.168. And MAT will also not be applicable. Don't forget that. That means, listen to me very carefully, the conditions that they have mentioned here, any company satisfying these conditions will definitely satisfy the condition of 115BA. And in 115BA the rate was 25, in BAA it is still lower. That means obviously if I have to leave the tax benefits only, then it is better that I go and take BAA and pay at this concessional rate. And that is why we brought this amendment, that any company going in 115BAA will be allowed to leave 115BA. You can leave 115BA. In fact, 115BA had more conditions. You had to be manufacturing company. In BAA, you don't even have that rule. Manufacturing or non-manufacturing, all companies will be allowed. Domestic company, second point, leave all your tax benefits, and third point, exercise your option before due date of filing return. And once you exercise the option, you cannot change. That rule is obviously going to be applicable. So you will have to leave all your tax benefits forever. Forever. Are you understanding? Are you understanding? So, brought forward losses also you will have to lose, and therefore CBDT has released a clarification that supposingly you have got brought forward losses with respect to these deductions. Can I say in the new tax regime you will have to leave? CBDT has told you to be smart. There is no start date to enter 115BAA. What have we studied in this paragraph? Once you take the benefit of 115BAA, then you are not allowed to leave. But there is no start date to opt for it. So do one thing, bring your brought forward losses, exhaust your brought forward losses, and after that move to your new tax regime. Till that time you continue in the old regime where you can take deduction and pay tax at higher rates and MAT will be applicable. Once your brought forward losses are exhausted, then shift to the new regime, leave all your tax benefits, pay tax at lower rates and MAT will also not be applicable. And any company which was earlier going in 115BA can now come and continue in BAA. Your tax rate, effective tax rate, all inclusive will be 25.168%. That means coming in 115BAA has got double benefit. Benefit number one, your rate of tax will be very low. Benefit number two, MAT will not be applicable. But will there still be some companies who will continue in the old regime? Yes, any company who wants to take these tax benefits will continue in the old regime. Rates of tax will be normal, 30% or 25% if turnover was up to 400 crores. Rates of tax will be normal and MAT will also be applicable. That means there are still some companies that will be covered in MAT. Though majority companies will go for this concessional tax rate and MAT not applicable, but there will still be some companies. That was BAA. Now, when BAA is introduced, do you understand all companies of the country, whether trading companies, service companies, manufacturing companies, everybody is getting benefit. Then the manufacturing sector, which was earlier getting an extra benefit, the manufacturing sector is saying, sir, what benefit we will get? So for manufacturing companies, we are introducing a new section, BAB, where the tax rate will be even lower, 15 plus 10% surcharge plus 4% cess, resulting into net rate of 17.16%. 17.16. So manufacturing companies tax rate will be even lower. What are the conditions? Domestic company, it should be a new company incorporated on or after 1st October and starts manufacturing before 31st March 23. What you should do is you should not dissolve an existing company and create a new company. That is clearly written. It should not be splitting up or reconstruction of an existing business. That is not going to be allowed. That means it should be altogether new company. This building that you are using should not be used earlier as a hotel or convention center. Just another condition. You should be doing only manufacturing and not doing any other business. And finally, that main condition, you will have to leave all the tax benefits, same tax benefits, 10AA, additional depreciation, 32 AD, scientific research, 35 AD, 35 triple CCCD, and once you exercise this option, you cannot change the option again. This is applicable over here also. This is applicable over here also. And if the assessing officer comes to know this amendment came in your section 92BA, specified domestic transaction, transfer pricing amendment. If the assessing officer comes to know that you have two companies, one manufacturing company where you have taken this option, and why is it advisable to take this option? Rate of tax is very, very low, plus MAT also not applicable. And you have another company, trading company, and you are dealing between the two companies at other than market price, then transfer pricing will be applicable, because it is possible that companies are showing more profit in this company for showing lower rate of tax, for taking the benefit of concessional rate of tax. It is possible that companies are booking profits in this company because this company is eligible for tax benefit. This company is eligible for tax benefit. So we will apply transfer pricing also, and obviously this option also once taken you cannot withdraw. So effectively non-manufacturing companies will go in 115BAA, or old manufacturing companies, existing companies will also go in 115BAA. Their all inclusive tax rate will be a reduced rate of 25.168%. And manufacturing companies newly incorporated on or after 1st October 19 will go in 115BAB. Already the rate of tax is very less, plus MAT will also not be applicable. So this will result in double benefit to the assessee. Already a concessional rate of tax plus minimum alternate tax is also not going to be applicable. This will bring double benefit to the assessee. But you will have to leave all your tax benefits which are prescribed over here. Option once exercised, you cannot change. So domestic company taking 30% tax, or if turnover up to 400 crore 2 years ago, 25% tax, MAT will also be applicable. If you go in 115BAA, BAB, rate of tax will also reduce and MAT also not applicable. So there is high motivating factor there. All companies in our country will shift to the new taxation regime. A big question arises. Will there still be some companies that will continue in the old regime? Yes. One, that company which has got all these deductions in huge quantum, then it is better that we take our deductions and pay tax at normal rates. And second, one more company, that's our last amendment, that if you opt for the new regime 115BAA, MAT will not be applicable, and then your accumulated MAT credit will lapse. What is MAT credit? Whenever your MAT is higher than normal tax, MAT credit will accrue, and in future whenever normal tax is higher than MAT, then MAT credit will be utilized. If you are shifting to the new tax regime, then there will be only normal tax, MAT calculation will only stop. If MAT calculation is only stopping, then how can you utilize your accumulated credit? Accumulated credit can be utilized only against your normal tax liability to bring it down to the level of MAT. But if there is no MAT only, then how can you utilize your credit? Your accumulated MAT credit will lapse, is what is clarified. So the moment you enter your new tax regime, there is only normal tax, there will be no MAT, then automatically if there is any brought forward MAT credit, it will be lapse. CBDT has released again another circular and given the assessee an idea that, dear assessees, there is no start date to enter 115BAA. Yes, once you enter, you cannot change. Once you enter, you cannot change, but there is no start date to enter 115BAA. Are we aware of that? Because there is no start date to enter 115BAA, you do one thing, bring forward your MAT credit, utilize your MAT credit. MAT credit can be carried forward up to a period of 15 years, and after you finish your MAT credit, then you can move to the new tax regime. So now actually there will be two types of companies that will continue in the old regime. Two types of companies. Type 1 company who wants to take all the tax benefits, then they will continue in the old regime, and type 2 company who wants to utilize brought forward MAT credit. Two types of companies will continue in the old tax regime. Are we clear? Otherwise, virtually over 90% companies of our country will move on to the new tax regime. The rate of tax is also very, very concessional, and plus second advantage, MAT is not going to be applicable. Are we clear? So some of the big amendments took place in our MAT chapter. Let's go ahead. AMT chapter, no amendment. This in my textbook finishes our volume 1. Now we come to the related part, that is IT authorities, no amendment. Search and seizure, no amendment. Assessment procedure, 2-3 small amendments have taken place, but they are very important amendments. First amendment is in the very first section, section 139(1), which is talking about filing of ROI. What is the existing rule? Every company, every firm, other people, if their gross total income, that is income after exemption before deduction, exceeds the basic exemption limit, and ROI having asset outside India. In that third assessee, individual, HUF, AOP, BOI, artificial judicial person, where we were saying income exceeds basic exemption limit. Which income we were checking? Gross income. That means we were taking all our exemptions but not taking our deductions. Now we are saying that in capital gain we get some benefits. 54. Whenever we sell an asset and acquire another asset, 54 was house against house. 54B is agricultural land against agricultural land. 54D was compulsory acquisition. EC was NHA RECL bonds. 54F was sell any asset other than house and acquire house. G and GA are shift from urban area to rural area or urban area to SEZ. 54GB was investing in manufacturing company or startup. These are exemptions which we take while computing our capital gains. That means this is an internal exemption in capital gains. Now what we will do is, you have to see your income before these exemptions. Means we will check our GTI before these exemptions. When we compute our GTI, does our GTI include our capital gains? And in that capital gains we have taken these tax benefits. So do one thing, reverse these tax benefits and check the amount. If that amount is exceeding the basic exemption limit. In other words, in simple language, you have to see your income before deduction. Can I say income before deduction is nothing but GTI? And now this GTI also you have to see before your 54 series. Pick up your gross total income, add back the exemptions that you have taken in the 54 series. If that amount exceeds the basic exemption limit, then filing of ROI is going to be compulsory. If that amount exceeds the basic exemption limit, then filing of ROI is going to be compulsory. So income before your exemptions under 54 you have to. This does not mean that from now you will not get 54. Are exemptions available? Yes, but to decide whether filing of ROI is compulsory or no, you we will check the income before exemptions, 54 series. But surprisingly, they have mentioned all the exemptions of 54, but 54EE, investment in specified mutual fund units, is not mentioned for filing of ROI. See, all these exemptions are going to be available, but we are checking for compulsory filing of ROI, we are checking the income before these exemptions. In that, we will disallow 54, 54B, D, E, C, F, G, GA, GB, everything, but we are not going to disallow 54EE. So pick up your gross total income, add all these exemptions, but don't add 54EE, and check if that amount is exceeding basic exemption limit, then filing of return is compulsory. If that amount exceeds the basic exemption limit, then filing of return is compulsory. But don't add 54EE. Don't add back 54EE. Are we understanding what is happening? And within the same section 139(1), one more new category of compulsory filing of ROI. Any person during the previous year who has deposited amount exceeding 1 crore in one or more current account maintained with bank. So, one account or multiple accounts, if your total deposits in any account exceed rupees 1 crore, or you have incurred foreign travelling expenses exceeding rupees 2 lakh. It can be for yourself or for any other person. For yourself or for any other person, foreign travelling exceeding rupees 2 lakh, or electricity bill exceeding rupees 1 lakh, or fulfilling any other conditions, then filing of return will be compulsory. So a new category of assessees are being covered for whom filing of return is going to be compulsory. Current account deposits exceeding 1 crore in one account or total of accounts. Foreign travel expenses exceeding 2 lakh. For yourself or other people, one trip or multiple trips. Foreign trip expenses exceeding 2 lakh. Or electricity consumption expenses exceeding rupees 1 lakh. If you fall in any of these, then also filing of return will be compulsory. So, for these people, there are 3 new people for whom filing of return is going to be compulsory. Are we clear about the 3 new people for whom filing of return is going to be compulsory? All of us? All of us? Okay, let's go ahead. Next amendment in assessment procedure chapter is in section 139A. Section 139A is the section for mandatory requirement of PAN. Till now, there are certain people for whom PAN is mandatory. For example, any person who is accessible to tax, if you are trustee of a trust, if you are in business and your turnover is exceeding 5 lakh rupees, if you want to take any kind of indirect tax registration. Now, just a small amendment that in this we will also include any other person as may be prescribed. In this, we will also include any other person as may be prescribed. So, they will give a rule that any other person as may be prescribed for which mandatory requirement of PAN is going to be applicable. Okay, let's go ahead. Next, again a very big change that has taken place. Very big change. We want to get the real purpose of Aadhaar in India. Aadhaar means unique ID, and therefore we just want to replace the requirement of PAN with Aadhaar, at least for small taxpayers. Individual taxpayers who have Aadhaar will now be able to use their Aadhaar instead of having PAN. So you can file your return by only quoting your Aadhaar. See, Aadhaar is going to be applicable for everybody and everybody will possess it. And now there are going to be 2 types of people. Any person who has got Aadhaar and does not have PAN, no problem, don't make any PAN application, write your Aadhaar number in your return file, in your return, and the income tax system will automatically allot you a PAN. System allotted 10-digit PAN. So you just quote your Aadhaar, their system will allot a PAN. But any person who already has PAN, it will be mandatory to link your PAN and Aadhaar. Otherwise, let me talk about this amendment first. If you don't link your PAN and Aadhaar, your PAN will be made inoperative. That existing PAN will be inoperative and the system will allot you a new PAN. And if you have been already allotted Aadhaar as well as PAN and you have linked also your Aadhaar as well as PAN, then in that case you can quote your Aadhaar number and you can file your return accordingly. So listen, what is the amendment? Any person who is required to furnish or intimate or quote his PAN, you have PAN, you don't have PAN but you have Aadhaar number, no problem, you quote your Aadhaar number and PAN will be systematically allotted to you automatically. So if you don't have PAN but you have Aadhaar, quote your Aadhaar, PAN will be automatically allotted. And if you have PAN and you have to link with your Aadhaar, if you don't link, what will happen? We already saw in point 4. Then again you furnish your Aadhaar number and already it is linked, so we know your PAN also. We know your PAN also. And people who are entering into prescribed transactions, who are earlier required to code their PAN in all the transactions like high value transactions, buying of vehicles or making bank fixed deposit, wherever you were required to quote your PAN in high value financial transaction, now you can quote your Aadhaar, and there is no problem because all Aadhaar will be linked with PAN. If you don't have PAN, system allotted PAN will be linked with Aadhaar, and if you have PAN, that PAN also you have to link, otherwise it will become inoperative. So quoting your Aadhaar number is as good as quoting your PAN, and therefore we are slowly and gradually doing away with the need or the requirement of having permanent account number. We will be maintaining all our database through Aadhaar only. These are the few amendments in assessment chapter. In appeals, revision, settlement commission, advance ruling, tonnage tax scheme, there is no amendment. The amendment has taken place in penalties and miscellaneous provision, and these two are not two amendments, they are one amendment only. A new section 269 SU has been introduced in the act, and if you don't comply with that, you have a penalty under 271 DB. So we already have 269 SS, non-compliance will attract penalty under 271 D. We already have 269 ST, not allowed to accept cash of 2 lakh or more, for which we have penalty in 271 DA. We already have 269 T, for which we have penalty under 271 E, and now we are in between these two sections, introducing a new section 269 SU and a penalty section between these two, that is 271 DB. So the rule is given in 269 SU and the failure will attract penalty in 271 DB. Are you understanding what is happening? Let us understand the rule and the corresponding penalty also. Any person who is doing business, so notice carefully, this is applicable only for assessee doing business. You will have to provide facility for accepting payment through prescribed electronic modes in addition to the facility of other electronic modes if your total sales turnover or gross receipts of the last financial year exceeded rupees 50 crore. 50 crore. So first of all, we are in which year? 1920. For 1920, you will have to check turnover of 1819. If in 1819 your turnover exceeded 50 crore rupees, if in 1819 your turnover exceeded 50 crore rupees, then are you already accepting payments to various modes? You may be accepting payment through cash, through check, account pay draft, electronic mode. Some people have swipe machine, debit card, credit card, swipe machine also. These are the existing modes, but now you will have to also provide facility. Whether the customer utilizes the facility or does not utilize is irrelevant. You will have to provide facility through other prescribed electronic modes. When they created the section, they said only other prescribed modes, but recently they released a circular and said this will cover your RuPay debit card, and this will also cover your UPI through Bhim. UPI interface, Bhim UPI will be covered. In other words, supposingly there is a big company selling diamonds. Last year the turnover was more than 50 crore. Then this year you have to accept cash, check, credit card, debit card, whatever you are following, plus you have to provide this facility to your customer. If you have a customer who wants to pay you in these modes, then you will have to provide this facility to your customer. And this amendment, be very careful. This amendment came from 1st November. Amendment has come from 1st November. So till 31st October, if you have not provided the facility to your customer, it is going to be alright. It is going to be completely alright if you have not provided this facility to your customer up to 31st October. From 1st November, you will have to provide the facility. Otherwise, your penalty will be 5,000 rupees per day. So where is the rule given? 269 SU. And if you don't comply with that rule, the penalty will be getting attracted under section 271 DB. So any assessee in business, if last year's turnover exceeded 50 crore, this year you have to provide facility. We don't mean that these are the only allowed modes. No, you can accept cash, but not more than 2 lakh, that is 269 ST, an existing section already. You can accept cash, you can accept check, you can accept credit debit card, but these extra facilities you will have to provide from 1st November. And if there is failure, per day you will have to pay, penalty of 5,000 rupees. 5,000 rupees per day penalty is going to get attracted. 5,000 rupees per day. So we are simultaneously done with two sections. 269 SU is the rule and 271 DB is the non-compliance penalty. Clear about this, all of you all? Let's go ahead. The next chapter in our order of textbook, next chapter which I do in class, TDS, TCS. Next chapter, TDS, TCS. In TDS, the amendments are very small amendments have taken place. Two new sections have been introduced. Let us see the small amendments one by one. First amendment in section 194A. What is the section 194A? TDS on interest other than securities. Part of your hot favorite sections of ICAI. Achij, hot favorite section. TDS under section 194A, the monetary limit is increased from 10,000 to 40,000. So what were the existing TDS limits? Normal limit 5,000. If payer is bank, then 10,000, and bank paying to senior citizen 50,000. So senior citizen limit 50,000 is as it is. Non-senior citizen monetary limit is being increased from 10,000 rupees to 40,000 rupees. So bank interest in saving account there is already no TDS. In FD/RD for non-senior citizen only after 40,000. Senior citizen 50,000 limit as it is. Next amendment, middle of the year with effect from 1st September 19, 194 DA is life insurance payment. Till now the rule was the TDS will be 1% on the amount if it is 1 lakh or more. But sometimes what happens when you are getting your maturity amount, it is taxable. Against that amount you get some deduction, some brokerage or some expenses that you have paid, because any expense that is incurred for the purpose of earning income will be allowed as a deduction. That means the assessee will offer the net amount to tax, and TDS was getting deducted on the gross amount, and thus a mismatch was happening. The amount in 26 AS was different from the income that the assessee is showing. So now we are changing the amount. We are saying the rate of TDS will be 5% on the amount of taxable income. So we will not deduct TDS on the gross income, we will deduct TDS on the net income, and because we are deducting TDS on the net income, we are changing the rate of TDS from the existing 1% to new 5%. So under section 194 DA, instead of the gross amount, TDS will be deducted on the net amount of income comprised, and instead of 1%, the rate will increase to 5%. Next amendment, this also amendment number 1 and 3 came in the interim budget. Mr. Piyush Goyal introduced it. Monetary limit of section 194I rent is now also increased from 1,80,000 to 2,40,000. So monetary limit is increased in two sections. Monetary limit is increased in two sections. Section 194A, monetary limit is increased from 10,000 to 40,000, and section 194I, monetary limit is increased from 1,80,000 to 2,40,000. Simple, easy amendments. So existing monetary limit was 1,80,000, new monetary limit is going to be 2,40,000. Very easy amendment. Next section, introduced with effect from 1st September. First of all, the amendment has come in the middle of the year, and a very big change, very big change. Payment to contractor, which is normally covered in 194C, payment of commission normally covered in 194H, and payment of professional fees normally covered under 194J. But in all these three sections, when the payment is being made by an individual or HUF and you were not covered under tax audit in the immediately preceding previous year, then you are excluded from the definition of the payer. But if you are making payment of more than 50 lakh, professional fees or commission or payment to contractor, then you will have to deduct 5%. So the definition of commission, brokerage, work done, fees for technical services, they are all same as what is defined in 194C, H and J respectively. It is all same, but individual HUF who are not deducting TDS under 194C, H and J. Who are those individuals? Who are those individuals? That is those individuals HUF who don't have tax audit last year. If you don't have tax audit last year, for example, a salaried employee will never have tax audit. If a salaried employee is paying money 60 lakh rupees for construction of his residential house, 60 lakh is a huge amount. But because he is a salaried employee, he will never get the chance to deduct TDS. And therefore, or supposingly you have paid a doctor rupees 60 lakh for some operation, and you are a salaried employee, you have paid 60 lakh rupees to a doctor for undergoing some operation, some plastic surgery or something. That is a huge amount, but you will never get TDS deduction under 194J. So now, if payment is exceeding rupees 50 lakhs, huge amount you are making payment, then 5% TDS will get attracted. If you are making payment exceeding rupees 50 lakh, what am I saying? If you are making payment exceeding rupees 50 lakh, then 5% TDS is going to get attracted. If you are making payment exceeding rupees 50 lakh, then 5% TDS will get attracted on contractor, commission as well as professional fees for those individual HUF not covered under tax audit. So by the way, company, firm, AOP, LLP will all deduct in 194CHJ. Individual HUF covered under tax audit will also deduct under those sections. Individual HUF not covered under tax audit will get deduction responsibility over here. And listen, this will cover personal payment also. This will cover personal payment also. So if you are making personal payment more than rupees 50 lakh, then although you are not deducting in 194C and 194J, personal payments do not attract TDS, but this section will apply on you and TDS is going to be deductible on personal payments as well. This section will apply and TDS will be deductible on personal payments also. Are we clear? All of us? Very, very important section that has been introduced. Very important section that has been introduced. Next section. Section 194IA. What is this section? TDS on sale of immovable property 50 lakh rupees or more. If the value of immovable property is 50 lakh rupees or more, then 1% TDS will be deducted. Now, it has been clarified that the value of immovable property, sometimes when we purchase property, we have to make some extra payment like club membership, parking fees, water fees, maintenance fees, any advance fee. All that is going to be included in your limit of 50 lakh rupees. So when you are applying the limit of 50 lakh, all these payments are going to be included. At the time of your 50 lakh amount, all these payments are going to be included. All these payments will be included while applying your monetary limit. Next, again from 1st September 19, a very, very important amendment has taken place. But amendment, be very careful. This is a very, very big place where student can go wrong. The amendment has become applicable from 1st September 19. If you are withdrawing cash from your account and you are withdrawing exceeding 1 crore, then 2% TDS will apply on the amount exceeding 1 crore. Therefore, example, if you are withdrawing 1.5 crore, then 2% will come on 50 lakh rupees. If you are withdrawing 1 crore 1 lakh, then only on 1 lakh, only on the amount exceeding 1 crore. Whenever you are withdrawing cash from your account, TDS will be deducted 2%. By the way, this is a rare case where this TDS will not be included in your income. Normally, TDS amount is always included in our income because it is deducted from your income. But here it is just a withdrawal from our own bank account. Withdrawing money from our own bank account can never be taxable income. So this is that rare occasion where you don't have to show this withdrawal as income. Normally, on whichever amount TDS is deducted, whether it is rent, commission, professional fees, the income has to be offered to tax and then only you will get TDS credit. But here you will get credit of 2%. Here you will get credit of 2%. Even if you are not offering the income to tax. How will you offer the income to tax? It is withdrawal from your own bank account. Where is the question of offering income to tax? You will not be offering this income to tax, but you will be getting the credit of TDS. So we want to curb cash in the economy. This will be only at the time of payment. So already there are 8 sections where TDS gets attracted only at the time of payment. This is the 9th case where TDS will come only at the time of payment. If you are having total withdrawals, exceeding rupees 1 crore. If you are having total withdrawals exceeding rupees 1 crore, then after 1 crore bank will deduct. After 1 crore. So first 1 crore there will be no TDS. After 1 crore TDS will be deducted by banking company, cooperative bank or post office. Because you can make your account with anybody, maintain your account with anybody. It can be a bank, a cooperative bank or a post office. If you are withdrawing more than 1 crore, up to 1 crore no TDS. After 1 crore 2% TDS will be attracted. But obviously, if payment is being made to government banking company or withdrawal through ATM or any other notified person, then In such a case, TDS cannot be attracted. For all other cases, be shocked if you want to, cash withdrawal from your own bank account, yes, you have heard it right, cash withdrawal from your own bank account is going to attract 2% TDS. Cash withdrawal from your own bank account is going to attract 2% TDS. You don't have to offer it to tax. Also, please be careful that the amendment has come from 1st September. That means if till 31st August you have withdrawn 10 crore rupees, there will be no TDS. From 1st September there will be TDS. And CBDT has released a circular stating that though till 31st August TDS will not be attracted, but for monetary limit purposes, because this 1 crore is in a previous year, so for monetary limit purposes, any withdrawals up to 31st August will be included for applying your monetary limit. In other words, if till 31st August you have withdrawn 3 crore, no TDS, because section came from 1st September. But then from 1st September, right from the first rupee, there will be TDS because 1 crore limit is already achieved. If till 31st August withdrawal is 80 lakhs, no TDS. Then from 1st September, you will get monetary limit of only 20 lakh because that 1 crore limit is per financial year. All this discussion applies only for the current year because it is the transitional year. From next year onwards, right from day 1, everything will be included in the monetary limit. So listen, withdrawals till 31st August will be included in monetary limit but will not suffer TDS. And from 1st September, TDS will start only on the excess over 1 crore. 194N newly introduced section. Are we clear about this? Let's go ahead. Advanced tax, there is no amendment. In advanced tax, there is no amendment. In refund chapter, small amendment that now you can get your TDS refund, or now any refund, advanced tax, TDS, any refund only by filing ROI. So that system of filling up form is now eliminated. Earlier there were two options. You can fill up an online form, or you can file your ROI. Now we will give you only one option. You will get your refund only and only by filing ROI. You will not get your refund with any other option. Only by filing ROI you will be getting your refund. Understood? Interest under 234 ABC, no amendment. Recovery proceedings also, no amendment. 234 ABC, no amendment, and recovery proceedings also, no amendment. Absolutely no amendment. And now we are left with very little in our amendment lecture. Major amendments are over. In volume 3 there are very few chapters, and transfer pricing chapter 32 and the remaining chapters, the amendments will continue in the next video please. Thank you very much.